Major funding for these broadcasts has been provided by grants from the CUNY TV Foundation, Capital One Bank, Genova Burns, Gian Tomasi and Webster, New York Community Bank, the Witkoff Group, M&T Bank, Perfect Building Maintenance, Chase Commercial Term Lending, Greenberg Traurig, LLP, Kilroy Architectural Windows, New York's Window Company. Additional funding is provided by grants from AKA Hotels, Corman Communities, Aerial Property Advisors, Bank of America Merrill Lynch, Bank Leumi USA, Briarwood Organization, CBRE, Colliers International NYC, Cushman and Wakefield, Customers Bank, DDG, Dime Savings Bank of Williamsburg, Eastern Union Funding, Flushing Bank, Friedman LLP, Gemini Real Estate Advisors LLC, Herrick Feinstein LLP, Hersha Hospitality Trust, Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides Centurion Holdings, Margolin Weiner and Evans LLP, Madison Realty Capital, Massey Knackle Realty Services, Matone Group, Meridian Capital Group, Newmark Grubb Knight Frank, New Banks, People's United Bank, RBS Citizens Bank, SJP Properties, Sterling and Sterling, Stonehenge Partners, TD Bank, Terra CRG, Urban American, and These Friends.
So here it is. It's 2014. As they would say, I have my little apple. Sometimes, is it the apple that, the prince ate? Or, is it going to be nice? Or is it going to be difficult? How is 2014 going to be? What's the effect of the economy? What's the effect of the rising stock market, all this, Dodd-Frank, and all that circumstance with regard to banking, real estate financing, commerce and industry financing? I really don't know that answer, so I've brought together today 4 individuals who truly understand the thoughts of where the banking world is going to be next year in 2014. My guests today include Jason Pendergist, who is the head of the Northeast for Chase Commercial Term Lending of J.P. Morgan Chase. Matt Galligan, who is the president of CIT Real Estate Finance, part of CIT Bank. Dick Ehst, who is the president, COO, and chief lending officer of Customers Bank. And last but not least, Mike Slocum, who is the president of the commercial bank for Capital One. You and I always joke Capital One. No venture card jokes tonight. Okay, nothing over there. Okay, how does the bank, see 2014? Where do you see the growth? Where do you see the opportunities? And as we were saying prior in the green room, do we see a lot of competition?
Well, I think competition is just going to keep on growing. There seems to be an unquenched thirst for assets of any sort, real estate, C&I, and banks are back on their feet and they're all looking for avenues for growth, and they're not earning any money on their deposits unless they're able to put it to work by making loans. So competition is tough and the economy is relatively flat. So therein lies, I think, a borrower's market.
I hate to say, you're just the 800, not 1,800-pound gorilla over there. I mean, J.P. Morgan is in every business, and you've been rather extensively involved, in the commercial term lending market over here. And I recently, I think I had a lunch with one of your colleagues, and he said you're going to be expanding your focus next year a little bit in commercial term lending. What are you going to be doing?
Yeah, as we look forward to 2014, we're excited with the opportunity in this marketplace, particularly in the commercial space. So we've come out, we've done a fair amount of business in the apartment lending space, in the mixed use space. We think now's a good time to put our toe back in the water with the commercial.
So what do you mean by commercial? Which, I mean, now you're telling these guys over here, they didn't know, but I had known about this. This was a little, what?
So the eyes get wide. For us, it's retail, it's industrial, it's office. As you look at the 5 boroughs, looking infill, CBD areas, as you look at Boston and DC, again, central business districts, we think now's a good time.
So you're going to focus the Chase commercial term lending, which was basically a multifamily product, which had some retail component to it, to now include retail, industrial, and other office buildings also.
Correct.
And you're going to try to do it in the same modus operandi of the similar approach of a low pricing scale and everything.
Yeah, our value proposition is built around the speed of execution and certainty of execution. So we've got to keep our streamlined process. We've got to keep a simple approach to looking at business. So we're looking, down the fairway, cash flowing deals, stabilized. It's the same business model that's been successful for us and all of us really at the table here on the multifamily space is looking for family ownership, long-term commitment to the market, good cash flow assets. Now we're just broadening that to the additional food groups that we really hadn't paid much attention to in the past.
Now, Matt, you and I have been friends for a number of years, but I remember when you started right at the beginning of the last recession at Bank of Ireland, okay? And then now you're at CIT, who's really changed over there, and you started the real estate finance. How do you see 2014? How do you see 2013? How do you see 2014?
It'll probably might be the toughest year of the two organizations that you talked about. I think it's going to be very competitive. I think that there is an unending quench for assets. My concern is that deal structures may end up to be more loose. The one thing that I'm hoping for is that the transaction volume will be high enough. And what the TomToms are telling me is that coming out of the CMBS deals, there'll be former CMBS deals, there'll be some opportunities. Also, we take more market risk, and I see that as an opportunity. Unlike Jason, for instance, that's doing, cash flowing deals, we're willing to go in and underwrite a marketplace. So to the extent that we can do that, some may not be able to. But under any circumstance, I think it's going to be a really, really tough year.
So, you're the new kid on the block. I mean, you're not the new kid on the block. I mean, you spent so many years with Sovereign over there. How do you, as a new $4.5 billion bank today, who I know is going to grow because look what you and Jay did when you were at Sovereign, how do you see the market? You're Pennsylvania-based, near Reading, Pennsylvania. You're in New York. You have some things in Westchester. Where do you see the world?
Well, I think first of all, we love New York, and I think we've had some near-term success in New York, and New York is such a huge market and creates, I think, significant opportunity for a number of sensible lenders. So I think we will continue to invest in New York and to make that. We'll do another $1 billion this year of multifamily lending in the 5 boroughs of New York.
You're going to be competing with these two guys over here. They're not going to give up on the multifamily.
I know, but there's enough space. I think in our world, there's enough space out there that we can enjoy, good relationships, without creating pricing and conditions that are, over the long term.
But you know what? I think
stand the test
bringing
of
up
time.
that comment, the pricing conditions, I think there are more competition because there's opportunities in the metro market.
Sure.
There may not be opportunities in the Philadelphia market as much as the New York market or the Boston market or different markets. There are opportunities and more people coming out there. But since there's competition, people are becoming, a little lax. And we do remember all of us have been around for the last recessions. And those laxes sometimes, because you need to put out a certain amount of business. And you don't want to lose that business. And how do you constrain yourself, because your bankers are over there, how do you constrain yourself to keep underwriting proper? And then you have the Dodd-Frank and you have the other situation.
You need management that'll support you pulling back, and that's you know, as we know, they're under pressure from shareholders, so it's a very difficult thing.
And right, and all four of you are publicly held companies. So you have shareholders, you have investors, you have to tell them. And when you go to the investors, like you said, you had an investor meeting. Where do you tell them the opportunities are for a Capital One bank in 2014?
Well, I oversee both C&I and real estate. So we do a lot of, as you were talking about, specialty finance things in the C&I space, and we've had good success and growth there. And in real estate, we still see some pretty good opportunities here in New York. So the CMBS market really hasn't come back. A lot of the international banks, like Bank of Ireland, you know, is gone and not to return. So there's still some velocity of opportunities here.
Now, you made a major acquisition, you know, buying a really great operation called Beach Street Capital, a DUS lender. What was the idea and the thoughts behind that?
We are one of the largest multifamily lenders in New York, but it was all on balance sheet, so we thought it made sense to offer alternatives for our borrowers. So Beach Street was a natural for us, and we bank a lot of the agency lenders. Beach Street was actually one of our clients. So we were looking to get into it. They were looking to partner up with somebody who could help them continue to grow. So it makes sense for us, and they have some other offices around the country that we might be able to leverage into doing a little other business outside of the footprint that we're actually in.
How was 2013 for Chase Commercial Term Lending?
We had a great year for our business in particular here in the East. We'd been running in place for the last few years. So 2013 was the first year of asset growth that we had a meaningful number of asset growth specifically here in Manhattan. If you look at our business overall, we grew our portfolio about 15%. So, you know, thrilled with that result. Really looking at the New York marketplace up and down the East Coast, you see really a kind of an unquenched demand coming up from tenants. So as you look at that apartment rental space, back to your question of, you know, how will we all compete in this landscape going forward, I don't think there's any shortage of people, young, old, midlife, that want to live in the city, whether it's Manhattan, whether it's Boston, whether it's DC, any of the markets that we all service well. I see that growing. I see that market expanding. With that should come values that rise, cash flows that rise, lending opportunities that will arise.
What about, you know, other asset classes that we're in? Mike was bringing up, you know, that basically he heads C&I and real estate. You handle both sides on that yourself. You're more on the real estate. There has been a large propensity of new hotels being built, new hotels planned, and, you know, they're going into a variety. But as I always say, how many hotels do we need in Long Island City? No, I'm not saying in Manhattan. I'm saying does Long Island City need 32 hotels, okay? Brooklyn at one time, when Josh Musk was the first one who went into Adams Street, it was a different world. How do you see the other asset classes, you know, the hospitality industry, the luxury condominium market, which has done very well? I mean, you're in 57th Street, which has been a great success.
They've all been very good.
All have been successful. How do you see those markets in 2014? Matt?
Well, you know, I was just in London, and walking down the street, you look at what things are selling for, and it makes this market look very cheap. Honestly, it's amazing.
Yeah.
And a great city, by the way. So I think you're going to continue to see people outside of this market buy. I am very concerned about crime in New York and whether or not we'll have the discipline to enforce the kind of lifestyle that we've lived over the last 10 or 12 years. And, you know, if you look at the numbers, there are 52 million people that spend $52 billion in New York City. They're coming in from overseas. And those are the people that are also buying condos, you know, that have the money to buy condos. So I think that market stays pretty firm.
Mike, what's your thought about the condo market?
We've done some of the condos, and we're in a number of the transactions. And you know, you think, boy, isn't there an end in sight for people that can afford to pay $15, $20, $50 million for condos? And it seems to be they keep showing up. So.
But what about the lower price condos? I mean, there are condos being built, you know, on the Upper East Side, I mean, the Upper West Side, there's limited, you really only get
Not to
Gary
be fresh,
Bartlett.
Mike, there are no lower price condos.
It's difficult
At land
to-
at $800 a foot, you have a $2,500 a foot condo, you know.
No, but you know, when we're talking about 57th Street, we're talking $4,000, $5,000, $7,000 a square foot. We're talking about.
$2,500 a foot is $2.5 million. I mean, that's a lot of money for.
I agree.
I mean,
But how do you know, as the new kid on the block, where do you see your opportunities in growth? Do you believe the condo market is something, or is that maybe a little too treacherous to start?
We want 10% of our total book in the condo market, and we're moving in that direction right now. So yeah, there's opportunity there.
I mean, look, retail has done exceptionally well. I mean, you've gone into Jersey. I remember you've had some things in Jersey on the Edgewater area. How's your thoughts about the New Jersey market?
well, we like New Jersey. I mean, for the reasons that you were talking about earlier, that it's an alternative. And, you know, Long Island City and Williamsburg, you were speaking before we came on about the price of land in Williamsburg being $350 a foot. You know, it makes New Jersey sound pretty good.
Mm-hmm. Mike, last year you did a number of really notable transactions, large dollar transactions, putting out high numbers in class properties. How you change your approach?
I think we'll continue to look for opportunities like that. So we have an appetite for lower leveraged, longer term assets. And so we've done some $150, $250 million financings on office buildings in Manhattan, lower leveraged for, we think, really good borrowers. And, you know, we compete with life companies a little bit, but the rest of our portfolio is really classified as short-term loans, credit card business. So it's actually a nice offset.
How do you see, you know, each one of you, I'm not, whoever wants to answer, Dodd-Frank, which still hasn't come up with their final comments, affecting the way you operate in business in 2014 and forward?
I think most of that will be invisible to the client. There might be a few extra due diligence questions we need to go through, but we're working hard to make sure that everything we do is behind the scenes. This is really internal documentation, internal processes and checklists that we need to go through. Clients don't need to be privy to how the sausage is made, as long as it comes out of the machine tasty.
I think what we're finding and what I think the industry will continue to experience is just added cost.
Yeah.
Right.
Just added cost.
Which is very, very significant added cost.
Absolutely.
Those people are very expensive, whether you're, you know, growing them yourself and paying them yourself or going out and buying turnkey people.
Yeah.
20% of our organization is within the credit or risk change or compliance chain. It's an enormous cost.
Do you see 2014 and years coming up? We didn't see that many mergers this year, you know, in the banking. Do you see with Dodd-Frank and with the changes potentially more mergers taking place?
I think there will be of small banks merging with other small banks. I think it's very difficult for our institution, or certainly yours, to do any kind of
that
sizable
institution, you know, that, okay,
It
but
may be shut down from mergers, but I think, you know, institutions of your size or smaller, particularly those under $1 billion, I think they're struggling with the costs that you're talking about.
Absolutely.
And so they're going to perish.
So here's a big question, you know, which normally people don't ask, but I'm going to ask it. How hard is it for you to find the next generation of bankers to take care of working for you and growing your business? You know, with the exception of my friend Jason over here, all of us are past 50 years of age, okay?
Time in the womb.
Okay, no. So my question is, and you know, if you look at this in retrospect, you know, each one of you have been in banking your entire career. How do you attract and how do you build that next generation of bankers?
Yeah,
Great question.
We've been working through that the last couple of years with our expansion here in New York, and it's been a challenge. It's how do you find the right person that has the mindset, the aptitude, the want to take a long-term approach to their career. I mean, banking is not something you jump into and jump out of.
You say,
5
you know,
or 10 years.
when you graduate, I want to be a banker. I mean, you know,
Yeah, it's you.
I mean, you go to Colgate, you say you want to be a banker, and you want to end up in Louisiana. You know, it's
Exactly. It's a lot of investment and a lot of weeding through folks to find the right character, right mindset, right skill set, and then giving them the opportunity. I mean, I think any young person really wants to build a career.
I mean, I will tell you, you go on a college campus and hang out a shingle and say you're hiring, and everybody shows up. And the talent that we see on college campuses, and we've developed a training program. I know you've got a really nice training program. We get some very talented people, and we mostly undergrads, and they, you know, you've got to find the right ones, but that's the only way.
The benefit
we've
you
found
guys
to
have
grow
are
that.
those training programs. We have one, but it's not nearly as extensive.
But you know what? You came from scratch. I mean, when you went over to CIT, they had no real estate, and you had to bring in, you know, you had to create your own team. How'd you find them?
Well, don't forget, I took 6 people from Bank of Ireland.
Right, but you have how many people now?
And then you network, and at that particular time, people were looking for jobs, and we were able to get very good people. We just had a recruiting process, and I can't tell you how much I agree with Mike. The kids that we saw, we interviewed 6 kids. You could have taken every one of them. It's heartbreaking that you can't. But they're just fabulous kids. I mean, I don't know what the hell I was doing. These guys have great grades, great activities, the internships they have, fabulous.
How are their communication skills? How is their basic understanding about how
I think
business
Dick
operates?
brings up a very important thing. They may be great students, but to really run, the biggest problem that I see in banking here, you know, is training that banker how to network, deal with people, you know, socialize, including some of your young bankers.
No
I remember
question.
a couple months ago,
No
I was at
question.
an event of yours. They're sitting together. Sitting together, to me, is not networking, you know?
That's really a good point. You know, I've got 14 people. Let's say 10 of them are junior, relatively junior people. One of them will get out there and do what you have to do, and she's really distinguishing herself. And you know, a colleague, a friend of ours, mutual friend of ours, who's a very brilliant, talented guy, he doesn't want to do that. He wants to be behind a computer. So trying to find that balance is very hard.
Yeah. We're actually, because of the fact that we haven't been able to find the volume of talent that we need to onboard kids in the lower areas of credit, you know, to really get them. We've been out and recruiting from colleges, and in the process of doing that, we have been somewhat disappointed in the basic skill sets that these kids have today. I had dinner with Margaret Hoover not too long ago. That's Herbert Hoover's great-granddaughter, and she was our guest at a Pennsylvania event. And she just wrote a book called The Millennials. And because in the audience was half business and half politicians. And her message was, if you're going to be recruiting and hiring the 19 to 34-year-olds, you better understand how they think in the business world. And if you're obviously expecting them to vote, you better understand their voting patterns. It was an enlightening experience for us. It really was. And the biggest issue they have is that their world, two things that kind of resonate with me. Their world ends at the end of their hands. Their ability to communicate thoughts, ideas, carry on progressive conversation is severely wanting. That's the first thing. And the second thing is that what she found out, and this is a large universe of people, obviously, that by the time these kids were 6 years old, they were patted on the back and thanked for just showing up. They got trophies for just showing up. So if you're going to employ them, you better be able to embrace them because that's what they're expecting.
Right.
So those two things are really a challenge, I think, for anyone who's trying to build and recruit into an organization.
So here's the next question.
Yeah.
You build and recruit, how do you retain?
Yeah.
Retaining good talent is the big problem.
Yeah.
You know, because some people say, you know, hey, I'm with J.P. Morgan, you know, I can get lost in the crowd. So they say, you know, there may be a better opportunity to go to a small shop. How do you retain? I mean, and I posed this a couple of months ago on a show, and I said to somebody, how do you compensate your people? We did a community banker show, and I said, how do you compensate? And how do you make the determination? How much is salary and how much is bonus? And that's part of how you have to look at banking in the next year. How do you pay people working for you?
Pretty good base salaries, depending upon the level, and then they get a decent bonus, maybe 30 to 50%.
But what is it predicated on?
Oh, it's of course performance.
Okay, but here's my question on performance, is what I said before. When your performance is measured by the volume of business, sometimes, you know, that performance might be deviated, that, you know, maybe there might have been.
I think Dick is on to something really important. You know, when you look at the kids that come in, they're all, you know, top of their class type of candidates. The challenge for us is to get somebody that has a balance of these skills, all right? I mean, in banking, if you didn't like people, you shouldn't go in banking. It's part sales, it's part credit, you know, it's got an analytical aspect of it. And you gotta wanna do all these sorts of things in order to perform. And it goes back to this person in our shop. You know, that person, very good analytically, wants to be out in the marketplace. It makes a big difference, and that person's gonna get paid for doing that.
How does Capital One, I mean, because you've really grown a bank from nothing over the last 10 years, 15 years. How do you keep retaining good talent?
I think you have to pay them fairly, and you have to give them opportunities to do different things. I think younger people today don't want to do one thing and kind of ride the seniority ladder up. I think they want to be able to shift around. So if they want to be a relationship manager or an underwriter, or if they want to move from New York to Washington, or as you did from California to New York, you know, you have to give them opportunities to do different things to keep them interested and fresh. And for us, we actually bring a lot of people in as interns when they're juniors and sophomores in college. And about half of the people that go into our training program actually were interns. So we saw how they behaved, how they interacted, and how they worked. And they saw what it was like working for us. And I think the retention of people that you bring in out of college is so much higher than those that you go out and recruit when they're 32 or 35. You know, they do feel a little bit of a sense of loyalty.
So the ownership piece of it.
So here's the next question. We know the enormous amount of advertising you do, branding. I mean, there's not an event that we don't see Capital One way or the other. It may not be the bank, or I think more of it's being geared to the bank than it used to be. It was the credit card. So now they say the bank and the credit card. How does the CIT brand, and how does in the future of in banking in 2014?
We create our brand by the relationships that we develop. So we do not do broad based advertising. Plus, we're basically a business bank, and in the business banking world, you know, we recruit teams, and those teams bring on board, you know, relationships.
Right. So you're more on, which they have also. Capital One has done this, a very service-oriented approach, where people, you know, the customer relationship of the team manager or the business person over there. How does CIT brand?
Well, what we had to do, because CIT, you know, had its challenges in the real estate market, we had to get out in the market and tell our story. And the biggest part of telling your story is use examples of what you've closed. And fortunately, we've been able to do that. And that's how we sell the brands now. We put a banner at such and such an event and those sorts of things. But as an organization, we don't do a lot of advertising. We do some business-to-business stuff. And I think the dollars into these organizations help us. You know, a lot of our business, a third of our business, is buying into participation. So being part of that network.
You have to be involved with banks and doing things. So I'd say in general, the apple should be shiny. It's looking nice for 2014. It's going to be a tough year to do a lot of good business, because there's a lot of competition and pricing may be a little inexpensive. But even with Dodd-Frank and all the rest, you know, the stars are aligned for positive things. And I'd like to thank Jason Matt, Dick, and Mike, and I'll see you next week.